Welcome back, ladies and gentlemen. You're listening to another edition of DIY Money.
DIY Money.
Logan's now on the video,
I
obviously.
love it. It's fire.
YouTube DIY Money Podcast. Is that what they do? Is that our
That's right.
channel?
DIY Money Podcast.
DIY Money Podcast on YouTube. We're going to slap it on the website, which is DIYmoney.org, and eventually cut it up for socials. Now, we've done this before. What's the difference this time? The difference this time is it's easy.
That's right.
It's super easy. Technology has evolved even in a short period of time. About 5 feet to the left of me is A. Howard sitting there and hitting buttons, and somehow it's magically going to the interweb, and bam, we're in your living room on YouTube.
That's exactly right.
And eventually on Spotify, however that happens.
And I just saw this is brand new. Netflix is now doing podcasts where they do the video, so eventually
Do you think we'll get on Netflix?
That'd be awesome, but probably not.
Well, that's a good goal of
There you
ours.
go.
I mean, why wouldn't they have DIY Money Podcast on Netflix?
They should.
Bam.
Bam.
Hello. I know if you're working at Netflix and you're watching or listening, let's get on there.
That's right.
Let's
Exactly.
do it. What's going on in your world?
What is going on? What you have a more exciting world than I do.
I do?
I think we need an update from the last time we talked. I know your eyes just rolled through the back of your head. I need an update of where your mind is at after kind of your recovery.
Yeah, recap. And we have a great community. This is one of the things I really look forward to leaning into, getting the DIY Money tribe going back again, just the community we have. The comments I have gotten from our DIY Money podcast listeners about the race that was not, meaning it did not go well a couple of weeks ago, was very humbling.
Yep.
I mean, very humbling. I cannot thank you enough, especially those of you that are like unbelievable runners. Friends of mine now in Tennessee, the Tuberts, and Zeph Levin, who's up in New York City and runs like 6 minute 50-second miles through Central Park. I'm like, what are you doing, dude? It's unbelievable. Like, just these comments. Blake down in Chattanooga, he sent me an Instagram reel, and it's a guy being like, I don't care if you had a bad race. I don't care if you got hurt. Like, do not quit. And I'm like, ugh. But it's a great outpouring. I will say this. I didn't have FOMO of missing the Boston Marathon until Marathon Monday of this week. Yeah. Now, this isn't going to air for a few weeks. This is airing in early May, but we're cutting this like on the Wednesday after Marathon Monday, Boston Marathon. Jacob Thompson, guest of the show, fan of the show, friend of the show, killed it, ran a 2:09.
It's unreal.
Unbelievable, 26 overall.
That's crazy.
26. It's unbelievable. Anyways, I didn't have FOMO until that.
Yep.
Until not Jacob. I'm never going to do Jacob. Until that Monday, all my friends, not all, some of my friends running it, the videos, the after, and I'm like, the dream lives.
So it motivated you a little bit. Yeah. Okay,
oh,
okay,
yeah.
okay,
Oh, yeah. That said, I have to, it's not going to be the focal point of this show. If I decide to sign up for another race and do it, which I probably will, I need to just tunnel vision it.
I got you.
And be very solo about it. Not that I'm going to do it in hiding and whatever. I'm sure we'll talk about it, but I just it's going to be a little bit more.
You just got to put your head down
on the DL.
Right? Yeah. I get it.
Yeah, because now I'm like it's game on.
I love it
to a degree.
Well, very good.
Anyway, so yeah, that's the excitement going on. But right now, I did reintroduce myself to the gym this week because for those of you that know, I had a hamstring issue, yada yada. But I couldn't do leg work. It's very, very important to do leg work while you're training and keep the legs strong and so forth, and avoids injury and helps with flexibility, blah, blah, blah. Well, I went this past week and I was like, okay, if I'm going to do this, regardless, I get back to running. I need to get back to consistent leg work. So I went in and I did a leg workout on Sunday. By Monday, I could not sit down or walk.
You can't sit or walk.
No, because the rear hurts. Like, it's a lot of glute stuff. My butt, and to this, it still is so painful. So, yeah, that's
well, you're back at it. I love it. It's very good.
I'm back at it.
Well, let's get to the housekeeping odds and ends. This episode and all episodes are sponsored by our wonderful sponsors. So let's take a brief break for them.
That was funny.
And well, I went back to the old days for a second, but we're good. Yeah. Now let's also remember that this show is ran by your questions. So definitely send us those questions to podcast@DIYmoney.org. That's podcast@DIYmoney.org. Check us out on those socials and the YouTube channel, like we talked about, DIY Money Podcast. Today, Quint, we have a back to the classroom episode because what is going on in my life is the markets, and watching these every day and watching the crazy volatility that we've had. Volatility just meaning ups and downs of the market. But we want to talk about that today, and we want to talk about the massive reversal and comeback of the market that we've had in the last few weeks. I know, again, this is going to air a couple weeks from now, but we've had a massive turnaround in the market from where we were in early and late March.
One of the fastest recoveries and biggest moves we've seen. I don't know the statistic. It's decades.
Yep.
It goes back decades, lots of 10-year periods. And so, again, as we're cutting this, it is now April 23rd, I think, 22nd or 23rd, 22nd. We're cutting this on April 22nd. Markets are at new all-time highs literally today. I don't know where they'll be in a couple weeks from now. But just a few weeks ago, the markets had rolled over. Many stocks had gotten hit very hard. The news was as negative as we've seen it.
Right.
But the reversal from the lows to the highs, the other day I did it, the NASDAQ alone has moved 17%.
It's hard to believe.
In just a few short weeks, and it's been straight up. Now, here's the lesson learned, and this is what we want to talk a little bit about. Number one, no one, I don't care what they say now, no one saw this coming.
Sure.
No one. Now, did we know that with a tweet or whatever they're calling them now, with a tweet or a change in the war or the conflict or whatever, could it move the market? Sure.
Right.
I didn't know, and I talk to, listen to, read a lot of people and a lot of smart people. But did they say, anybody say we'll be at new highs in a matter of 2 or 3 weeks?
Or
with,
12
by the way,
consecutive NASDAQ updates.
With, by the way, there's no resolution.
Right.
There's really no resolution here. So this was out of left field. And we went from being something like 2 standard deviations on the downside. So again, we talked about a risk metric on previous episodes, and you have an average, bring you back to statistics class, think of a bell curve. You have an average, and then you have 1 standard deviation, which is an average plus, a little bit on the right and a little bit on the left, and then 2 standard deviations with a little bit more. And the farther out you go, the higher probability is. So like 1 standard deviation is 13.6% on either side, right? So that's about 27%. You go out another standard deviation and it comes up to like what, 75% total, something like that. Am I butchering it?
Not even close, but that's okay.
What is the first standard deviation?
34% on either side.
Yeah. Then 13. Sorry, 34, 68. Then 13, which equates to what, 90-some%. So we were already at, is that right?
You're closer now. Yeah.
Okay. So we were already in that second standard deviation on the downside. Like, this is a problem. We have moved 2 standard deviations. We now swung all the way over to the other side of standard deviation. 2 standard deviations on the right. Like the weather, which is about the last time we talked about this.
Exactly.
We literally used the weather example and how the weather in Kentucky swings so randomly, markets can do the same thing. And so, again, why are we saying all this? Because if you went in during this, before this, whatever it is, and you said, I don't like this, this isn't good, I'm going to sell out, I'm going to wait and see, I'm going to, take some off the table, whatever it is. And I want to clarify, I don't mean a rebalance. I don't mean coming into this year and saying, you know what, I'm a little heavy on the equity side, I need to rebalance. I mean allowing the news, the volatility, the market price action dictate what you're doing in your portfolio. That's the difference between strategic rebalance, asset allocation, and market timing. And if you did that, and if you're listening right now or watching and you did that, you are sitting on the sidelines and you're going, well, I don't want to buy now.
Right.
And you have entered the vortex of bad decision-making and investments.
Sure.
And it is why, I'll conclude, I'll kick it to you, I promise. It is why, if you ever pull up that chart, average investor return, I'll never forget, JP Morgan, Fidelity, they've done studies. The average investor return on a retail investor is something like 2%, less than 2% over a long period of time. Why? Because they do stupid things. They do dumb things. All right, I'm done for a little while.
Well, and let's think about this too. If you were someone that didn't make any changes or didn't make a bad decision, didn't pull out of the market, now you're in that vortex like you talked about. I can almost promise you, and I can't promise anything, but I can almost promise you that if you were sitting that Monday and Tuesday before we saw the rally, when we were getting news headlines that was pretty serious and pretty dramatic, I don't think you were sitting there going, this is a great buying opportunity. So people have to know that, like, it is so difficult to time the market. And that's why you don't do it. That's why you don't jump out and jump back in. What I also think people will probably realize, especially if they were someone that's been super aggressive in the past, you might have, over the course of a 6-week time period that this conflict and war has been going on, realize that you're over allocated in your allocation. I've talked many times on this podcast that you don't know what your allocation is until a market goes down, until you get kind of punched in the face, Mike Tyson style. So you may have realized that when you saw the market go down somewhere between 10 and 15% over the course of 4 or 5 weeks. Wow, my sleeping on the pillow index is not doing great right now. Like, I am not handling this decline well. And hopefully you didn't make a poor decision. Hopefully you stayed invested in the market. But if you did go through that, and now we're at highs, you're getting another opportunity to get that allocation right, to rebalance to an appropriate allocation for your plan, for your investment horizon. You probably don't need a 10% on average return for your plan to work. Maybe you only need an 8% on average return or a 7% on average return. So adjust your portfolio accordingly, but adjust it when the sun's out. Don't adjust it when you're in the middle of a thunderstorm.
I love that. And I will add to that a couple of things. If you went through it and you were uncomfortable, but you were thinking, I've got a long time horizon, it's uncomfortable, maybe this kind of sucks. I mean, I was doing that.
Yeah.
I'm fairly aggressive, and the numbers, I'm blessed with big numbers, and wow, I was like, well, this kind of sucks.
Yep.
But I knew my time horizon's long. I have, again, and I'm facing retirement. Like, it was the first time in my life that I'm actually facing a retirement date and going through this market volatility. I was like, oh, maybe my allocation's too aggressive. It wasn't. But now that you've gone through it, it's probably not your first rodeo.
Right.
And it should be getting more palatable.
Yep.
Now, I will promise you, there's going to come one in your career or your time or wherever where it's like, no, this is too much. Those are your 08 and 09s. Those are your 2000. That even is your COVID, where you're thinking, oh my goodness, this is too much, etc. But when we were doing a podcast and we were saying things like, you never know what it is. You don't know what it is. And here we are, we're facing conflict, geopolitical conflict, which is usually good for markets. But this one is really wreaking havoc because it has to do with the Strait of Hormuz and yada, yada. And no one would have predicted that. We don't know what the next one will be.
Yep.
It will be something different. Heck, maybe it could be this one again. I don't know. But it will be something different. It will be scary. It will be uncertain. You will have people coming out of the woodwork saying, oh, no, this time is the time. But at the end of the day, never forget, what you are investing in is capitalist humans that are making decisions with the same information we have.
Right.
And they're in charge of businesses, whether they pivot, whether they do something different. I mean, this is an extreme, but in the last couple of weeks, we had a shoe company pivot into AI.
Right.
Right? I mean, it's almost ludicrous, and maybe signs of quite a bubble in that area.
Yep.
I don't know. I'm not going to put a dog in that fight, but companies pivot. And they pivot all the time, and they pivot with the information that we have. And what we're doing is we're investing in these businesses and saying, listen, nobody may be buying burgers right now because they want to stay at home. Their markets are down. They want to make peanut butter and jelly sandwiches. But are we going to stop selling burgers in our country?
Sure.
Are we going to stop selling Coca-Cola in our country? I mean, the answer is no. And how do I know that? Because we've gone through world wars, we've gone through depressions, we've gone through recessions. People eat burgers, people drink Coca-Cola, people fill up their car with gas, people, I mean, to keep their lights on, like you name it. And this is what we're buying. So I wanted to just do a recap. Just once again, bravo to you for doing nothing, right? Bravo to you for having an appropriate allocation. Bravo to you for putting another notch in the belt of going, you know what? Yeah, that stunk. I didn't like it. I didn't like opening my account statement, but I stuck to the plan. Bravo to you, because that's a DIY money trajectory of how to create wealth in the long term. So, Steve, producer Steve, little round of applause for our DIY money audience, please. Yes, it's happening. Great. I don't have anything else. What else you got?
I think that's it.
All right. Remember, friends, the secret to wealth is pretty simple. Live on less than you make, invest the rest, and do so for a very long time. Make it a great one.